I want to invite you inside the classroom.
So the first thing we have to understand is that the banks do business the same way every day. All right. And so think about it this way. When, let's just say, and I'm going to take us back to beginner class for a moment, right? So let's say a corporation is going to, let's just call it an American corporation, right? And let's say that they're going to purchase, some kind of parts or something, right? From a Japanese corporation. Well, here's what they don't do. They don't just mail a check, right? They don't just mail a check over there. What actually ends up happening is that we see this corporation's bank moves money. So we have the corporation that has a bank, and most of these corporations have numerous accounts and banks that they do business from different, like normal businesses do, right? Well, then let's just say this is their spending account or their supply account, right? And so what happens is that account then puts the order in to the exchange, okay? And then the exchange has to look and say, okay, I have US dollars here that have to be converted into yen. And they say to themselves, we'll just put an E here for exchange. They say to themselves, at the current rate, let's just say of, 1.121, right? Or something like that. And so they look at that and they say, at the current rate, we would have to exchange at, let's just say this level right here. So this is how much money this exchange is right now. And so this is how many units, right? So let's just say the units put the price up, because the more demand there is for a certain currency, the higher the price goes. So this is a large order. This is one company of millions of companies throughout the world. And so what happens here is this: the exchange looks at that and says, what other companies, what other corporations, what other banks are moving money in this same manner right now? And they look and they say, if we can communicate, if we have to move $10 million of currency, and this bank has to move $20 million of currency, and this bank has to move $40 million of currency, well, now suddenly we have $70 million of currency. And so the more need, the higher the price rises. Well, when the order came in, this was the current price that was locked in, right? Does that make sense so far? So when the order came in, when the first order came in, price was here. As more orders keep coming in, the price goes up. So what this bank does is says, well, wait a minute. Why would I want to go and do business here if I could do business here? Why would I sell these dollars to the Japanese bank at this price if I could sell it at this price like these banks are? Okay, so now suddenly there's a little bit of jealousy. If you're not really jealousy, I'm joking with that, but now suddenly there's some fluctuation in price. So now that price may only be a penny. It might even be less than that. It might be a tenth of a penny, right? So a tenth of a penny is 10 pips. So anyway, so here's the thing. These people can't call these people and say, would you pay more? But what they can do is say, since we know that you guys are selling here, and when that sale happens, price is going to come down. Okay, here's what we can do. We can go ahead and add more of our own dollars from other accounts, from other businesses, from other investments, right? That's the money sitting in your savings account. That's the money that the bank has that they can invest. And they can say, why don't we do this? Why don't we go ahead and take more money, dump it in at this price, so that when the price comes down, we've made money off of this to negate what we didn't make on this. Does that make sense to everybody so far? So now this batch of money is being sold here, and this batch of money is being sold here. So when the price comes back down, what do they end up doing? They go and they buy back that same currency at the original rate or lower, depending on how low the market goes. They go and they buy back their currency to, replenish their lenders, and that money is bought at a lower price. So this right here becomes their margin of profit. Okay. And so this is called market manipulation. When we look at it here, from here to here, this is all profit. This right here, from here to here, that's break even. And anything that goes beyond that becomes a loss. And so they're okay with taking a loss as long as their win or their investment pays more than their loss. Okay. So that's how a bank like this rides the momentum of other banks and makes money off of your money. So your money that's sitting in a savings account right now, let's say your money is sitting in the same bank that this guy banks with. Let's say this corporation right here banks with let's call it BOA, right? Bank of America. So they bank with BOA, and you, little guy with a couple $1,000s in the account, also banks with BOA. Well, here's what happens. When you go to your savings account, you open up a savings account, you end up having, let's say you have $300 in your savings account, $1,000, $3 million, whatever you have in your savings account. They've promised you a certain rate of return, 0.003% or something annually, which is peanuts. You end of the year, you probably made $3 or something, right? You're giving those people permission, the bank, to invest that money at a profit. So they're seeing the big money movers really move the millions and even the billions, while your money is not moving anything. But you've given the banks rights to use that money to help the market move. So now when the market moves, the banks take all of your little savings money and all the money that they've been given permission to invest with, and they dump it in. They drive the price even a little bit higher, and they make their sales. They dump it in, push the price up, and when the price goes up, they sell. Okay? And then when that happens, big dump offs happen. This is called supply. Demand rises, the need is supplied, price drops. Because now demand was high, supply was low. Now all of the supply that was met to meet that demand probably outweighed that demand, and now there's more supply than there is demand. Now the price drops. And so now suddenly you have banks saying, now that the price is dropping, these same people are saying, well, guess what? I've got to make sure I pay that 3%, and we need to be able to get our money, our millions back out of these investments. So as price drops back, they go and they buy back this currency that is dropping in price, and then that's how they make money. They're doing the same thing you and I are doing. They're just not doing it on leveraged accounts. They are taking US dollars, trading it for other currencies, and then trading it back and getting that currency back as price changes and keeping the profits, flicking you the pennies. So here's the next step of that. American corporation is moving money over here. They go to the exchange. Well, here's the thing. These people have computers and they have trackers, and they have charts, and they have floor traders, and they have all kinds of stuff going on. All right. We just need to know the time they are moving. Yeah. All right. I'll get to that in a minute. But I'm saying these people have a lot of stuff going on where you and I are just looking at a chart, right? So here's the thing. These people have floor traders and market analysts and all kinds of stuff happening. Okay. And so here's what they do. Do you think that it's profitable? Don't you think that the banks do business like that has multi-transactions and stuff? So let's say, for an example, US dollar to Japanese yen, let's say UJ, for an example, is looking like this. So essentially, US dollar is going up, Japanese yen's coming down, something like that, right? So here's the thing what happens. The banks don't just say, let me sell my US dollars and get Japanese yen and fill this order. Here's what they do. They look and they see, since dollar is growing strength against yen, which means that price is going up, what other currencies out there are also either gaining more strength against yen, or are losing strength against dollars? Why do they do that? Because let's say that's what UJ looks like. So yen, dollar is growing, yen is dropping. Let's say GU also looks like that. Well, here's what that tells us. If UJ looks like this, that means either one of two things is happening. Either dollar is strong or yen is weak. If GU looks like this, that means that either pound is strong or dollar is weak. So let's say the case is, and again, this is multi-level, this is multifaceted analysis. Then they go and they look at something like EG, right? And they see that EG is going down, which means that either euro is weak or pound is strong. So once they do their analysis of all of the different currencies, this is called currency correlation. Okay. Now you might want to write that down, take that note. It's called currency correlation. So then they look and they see that across the board, the GBP is rising and the dollar, even though it might be rising against the yen, is actually falling against almost everything else, which really means that the yen is quite weak. If the dollar, which is falling against all other currencies, but rising against yen, that means that the yen is weak, the dollar is weak too, but just less weak, and that other things are stronger, okay? So why is that important? Because watch this. The banks say, I can take a weak currency and sell it for a weaker currency and watch a rise, okay? A normal rise. But if I can find another currency that's even stronger than the one that I'm buying now, let's say in this case it's GBP, then rather than a UJ that looks like this, I could essentially get a GJ that looks like this. Okay? Why? Because now I'm not going for a weak currency that's just a little bit stronger than another weak currency. Now I'm getting a strong currency against a weak currency. Okay? Which causes bigger movement and higher profitability. So once they do their correlation, here's what they'll end up doing. They'll end up saying, watch this. Let me take this US dollar orders that I have and let's trade them for GBP. Then let's take those pounds and trade them for yen. So they make money here. They make more money here. Then they go back and they wait. And because now that they have something that is cycling, when it comes time to sell, guess what they do? they take those yen and they wait for the cycle. So they wait for the cycle, and that's when they make their move, right? So, excuse me, they would want to get a timing right, and they know this timing, where they're essentially selling their currency back, buying the currency back, flattening out their orders, selling. That becomes a head and shoulders. Why? Because they took American dollars, US dollars. The exchange said, what's the most profitable currency? Rather than me just going straight here to the yen, I'm going to make a middleman here. I'm going to trade it for an even stronger currency. I'm going to take a small loss here, or maybe break even, or maybe even make a small profit, depending on their timing. And then I'm going to make a much larger win here, gain a bunch of profits, only to give back at a lower rate and get that back to bring it even.
This was a sample of what it's like inside the TTA classroom. I know this brought you value, but if you want to unlock the full potential of all the value that the TTA classroom can bring, I want you to click that link in the description below, trendtrading.academy, and become a student. Remember guys, you got to invest in yourself before you invest in the markets. I'll see you in the next video.